Good evening, class. We're going to spend a few minutes tonight in chapter 13 talking about fiscal policy, government's approach to fiscal policy. But before we do, again, want to go back and talk just a few minutes about what we discussed in chapter 12 when it came to monetary policy, because monetary policy and fiscal policy are two somewhat different alternatives to the United States, as maybe with other countries, how they go about controlling inflationary gaps, recessionary gaps, how to keep the economy moving along. So when we talked about U.S. monetary policy, we talked about the goals of monetary power, and it was what? Full employment, avoiding excessive inflation recession, or inflation deflation, depending on how you want to look at it. And three, growth in potential GDP. And then the authors discussed in their text the government mandate, so the Federal Reserve Act of 1913 that created the Federal Reserve, or created the central bank for the United States, and the tools that the Fed would use to influence economic activity, buy and sell government bonds via their open market operations or transactions. They change the discount rate. They change the reserve requirements that dictate how or what percentage of a bank's checkable deposits have to be held in reserve. And then finally, they can change the interest rate that they pay to banks on their reserve holdings. And then the authors spent a fair amount of time talking about expansionary monetary policy, contractionary monetary policy, and how it impacted both inflationary and recessionary gaps, and how it tried to smooth out and keep the economy growing at a somewhat consistent rate. And the Fed's targets, when the authors discussed those in the text, they were interest rates, money growth rates, and the price level and expected changes in the price level, because consumers, investors, profit maximizing firms, government agencies, they all are trying to monitor the price level and trying to determine what the expected changes in the price level might be. And then as they kind of tied down or tied up the end of that chapter 12, they talked about challenges with monetary policy. And we all know there are challenges to, for the most part, every strategy that the government develops and implements, and that's no different with monetary policy. And we're going to find out with fiscal policy that there are going to be some challenges too. And challenges in monetary policy, you've got lags in policy. You've got political pressures from the government, even though the Fed doesn't report directly to the government, an independent central bank, there will be from time to time pressures from the government. The degree of impact on the economy of monetary policy, and rational expectations. And rational expectations theory, the authors talked about that for a few minutes, but consumers, investors, firms, rational expectations, everybody is trying to develop expectations and set expectations on the impact, especially the magnitude of the impact of monetary policy. And then as they wound up chapter 12, they talked about the trade-off between inflation and unemployment. And they spent a fair amount of time talking about the Phillips curve. And I think it was 1956 it was developed. And it did reasonably well as far as tracking, forecasting, explaining the trade-offs between inflation and unemployment until we got to the 70s and 80s. And then the wheels just completely fell off, at least on the short-run model. And then they moved it to the long-run model, and it did somewhat of a better job on long-run model. But again, their models all have flaws, and no matter how well they perform for over a time period, there's always I was going to say probability, at least there's always the possibility that the wheels are going to fall off that model. And with that, we're going to kind of wrap up chapter 12 as far as a review, and we're going to jump into chapter 13. We're going to talk about fiscal policy. And within the United States and within many other global economies, there is fiscal policy, which is the government's power. And then you've got the central bank, which is monetary policy, which we discussed in chapter 12. And the combination of those two try to steer the economy towards its potential output. And as far as, especially on the fiscal policy, what drives the economy towards its potential output, you've got activities, and they list several in the text, but the first one they talk about is government purchases. Government purchases as a component of aggregate demand, which we discussed in one of the previous chapters. Purchases of goods and services produced by firm and directly produced by other government agencies. So they're either purchasing goods and services from firms, for the most part profit maximizing firms, or they can be directly produced by other government agencies. And it is declining as a share of GDP, even though GDP overall is increasing. And when you talk about government purchases, not only do you have federal government, you've got state government, you've got county governments, you've got local governments, you've got city governments. You have a lot of government agencies that are involved in government purchases. And want to make sure that you understand the difference between government purchases, so between government purchases and government spending. And we've gone through that on several occasions, but remember, government purchases and government spending, there is definitely a difference between those two. It's, overall it's increasing, but again, it is the government purchases are declining as a percent of GDP. And then the second opportunity on the fiscal policy, you've got transfer payments. And this is the huge segment of government spending. Payments are made by governments that don't require the recipients to produce goods and services. Social Security, electronic benefit cards, welfare payments. Electronic benefit cards have taken the place of food stamps, but again, it is a subsidy type or a transfer payment to help individuals be able to purchase foods to ensure the livelihood of their family. And again, you've got welfare. You've got things like the WIC program, women, infant, and children. And then when you talk about also transfer payments, we're starting to talk now, about Medicare and Medicaid. And if you've ever had a health econ course, one of the first things most economists talk about is an article by Kenneth Arrow that was published in 1963. So he probably started writing or at least researching the information for that article maybe in the late 50s or maybe early in the 60s, but wasn't published until 63. And he talked about transfer payments, talked about healthcare in general, and it is viewed by most economists, or at least healthcare economists, as kind of the preeminent journal article or document that kind of spurred changes in healthcare systems. So Arrow's article was purchased in 63. In 1965, I think it was Lyndon Johnson, signed the policy that created Medicare and Medicaid. 66, DOD brought, Champus, or now it's called TRICARE, into existence, even though the VA had been in existence for some time. Arrow's article appeared to generate a lot of interest in the healthcare system, and because it generated all this interest in the healthcare system, and economists tried to correlate the kind of the somewhat explosion in the healthcare system, especially on the public side, when you had Medicare, Medicaid, Champus, or that's called TRICARE, when you had all of those were I guess, implemented or developed, and government policy started allocating funds to support them. Economists tried to link Arrow's article to these developments in the healthcare rate, and for the most part, I probably agree with them. I think it was kind of an eye-opening article for a lot of policymakers, and I think it did spur some of the interest in changing the healthcare system. And welfare benefits are extended on eligibility and increase during recessions. They can be cash and transfer payment, stimulus checks. They can be food stamps. They can be Medicaid. And it's driven by loss of income, loss of jobs, bad luck. You don't really have to produce goods and services. You just have to qualify for them. And then the authors jump in and start talking about taxes. And taxes reflect the relationship between real GDP and personal disposable income. Personal income, really disposable income, affects the level of consumption. And I've lived in the past, I will argue the two states that have the most inefficient tax systems in the United States. I've lived in California. I live in the state of New York. Now, some individuals will argue New Jersey's right up there with New York and California, and they may very well be. I just haven't lived in New Jersey. But the drain on an individual's paycheck in the states of California and New York, it's almost unbelievable, and you have to have you almost had to have worked in either California, New Jersey, and again, I'll include New Jersey. So California, New York, and New Jersey, you've almost had to work in one of those states just to experience the drain on your paycheck of money that is taken out in taxes. And I used to just cringe thinking about April the 15th because I was so depressed trying to fill out my taxes and looking at my tax return. And no matter how many dollars that were taken out in state taxes in one of those three states, I still almost ended up having to pay every year some state income taxes because it was such a drain on your personal income. And you're extremely lucky if you are a resident of Tennessee. There's no state income tax in Tennessee. Florida, Tennessee, Nevada, state of Washington, Texas, one of the Dakotas maybe. So there are a few states in the United States that have no state income tax. So if you are a student and you're getting ready to get on the job market, or whenever you get ready to get on the job market, just keep that in mind that get on the internet and figure out which states don't have any state income tax, and it's depending on what the level of state income tax, it can be a significant bump in your personal income. Taxes on firms affect the profitability of investment decisions, level of investments that firms choose. And that is true. So firms are going to migrate towards states in a lot of instances where they have lower corporate tax rates on firms' profitability. Because remember, we talked in one of the earlier classes about when you were talking about taxes and partnerships, sole proprietors, taxes that you make on those businesses treated as personal income tax, limited liability, an LLC, it's still treated as personal income. But when you get into a corporation, when you get into like an S corp, and you're traded on one of the exchanges, you are double dip. You're paid. You have to pay corporate taxes, and then as dividends are passed on to your stockholders or shareholders, they're having to pay personal taxes on those dividends. So payroll taxes offset the cost of hiring workers, impact the employment and real wages earned by workers. So payroll taxes, again, state of New York, state of California, seem like on the payroll taxes, again, getting drained by if you work for a company in one of those states. The bulk of federal tax receipts come from what? Payroll taxes and personal income taxes. The bulk of state and local government receipts are generated by basically sales tax and property taxes. Fees and grants, emissions of certain programs, somewhat drive some of your state and local taxes, but the bulk of state and local government receipts come from either sales tax or property taxes. I went to graduate school at Ohio State, lived in a suburb called Westerville, and my paycheck was taxed on federal taxes, state of Ohio, city of Columbus, because Ohio State was in Columbus, Westerville city taxes, because then they taxed my personal income tax because I lived in the city of Westerville, and also had to pay Franklin County personal income taxes. So I was, individuals working at Ohio State and other, firms or organizations within the city limits of Columbus, where we were being taxed to death based on where we live. And with that, we're gonna stop. And when I come back, we're going to talk about what the government's budget balance looks like. And if you're listening to anybody on TV these days, it is a really ugly picture. So when we come back, we'll talk about the government's and can they balance the budget.